Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Brian Curtis along with Doug Krisner. Join us each day for the stories making news and moving markets in the Asia Pacific. You can subscribe to the show anywhere you get your podcasts and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
All right, let's get to that. Closing arguments in Donald Trump's hush money trial today ran very long and late. Joining us live is Hadriana Lowenkron, who is a national politics reporter. Thank you, Hadriana. Really appreciate it. You were in court today. Now, we're going to go through what happened, but that was a long day. What did it adjourn to, 8 Eastern?
Yes, it was definitely a long day. We started at around 9:30, 9:45, wrapped up at around 8 p.m. It was a 6-hour-long summation from the prosecution. It was a bit over 2.5 hours, I would say, for the defense, which is what we began our morning with. So it was a long day for sure.
So let's go through it. Defense first, and the theme would be that both Stormy Daniels and Michael Cohen are liars, correct?
Right. So essentially, Todd Blanche has been arguing that Trump committed no crimes and that Stormy Daniels, the adult film actress, part of the centerpiece of this big puzzle here, was trying to extort money from Trump in 2016. Blanche even produced a top 10 list of reasonable doubts for jurors. As you know, all we need is one juror to have some form of reasonable doubt to prevent a conviction here. And so part of that list included a claim that prosecutors failed to produce evidence that Trump used some unlawful means to influence the election, that Trump himself never reviewed checks he signed for Michael Cohen because he was too busy running the country, kind of portraying this as something that his associates had done without him being aware because he was in the capacity of president and therefore was not paying attention to this issue. So that was really what Blanche was trying to argue here.
Yeah. Now, the prosecution, its job then was to go back and try to back up what Cohen and Daniels had testified.
Right. And so we knew all along, having Michael Cohen be the star witness could be potentially risky for the prosecution, just given, of course, his own criminal history. So a big part of, the direct and the questioning of Cohen, as well as now here in the wrap up for the prosecution, has been to try to get around Cohen's credibility problems, really pointing to instances of corroboration with other witnesses that were called to testify, such as David Pecker, who ran of National Enquirer, which, as we all know from earlier in the trial, had agreed to be the kind of eyes and ears of the campaign and catch and kill, really, buying stories that were negative about Trump and then not publishing them, publishing hit pieces on Trump's opponents, and then also publishing positive pieces on Trump. So a big part of the prosecution was to, again, try to get try to prove that there wasn't as much of a credibility issue with Cohen, that there were other witnesses who corroborated it, as well as to lay out their own evidence with phone records, et cetera, showing that Trump did, in fact, know that all of this was taking place, even using his own tweets, where he, said very plainly this was a reimbursement to Michael Cohen.
Now, just go through the ground rules here. The prosecution had to raise the bar to election fraud to make this a felony. Is there any way that the jury, and we understand they come back tomorrow, I'll ask you about that, that the jury or the judge can come back and say no felony but convict of a misdemeanor?
That's something that is something that I think we'll learn more about tomorrow, because the judge has to kind of instruct the jury. He's going to spend about an hour or so tomorrow morning. They're coming back at 10. Usually it's 9:30, but we get a half hour of sleeping in. So the judge will really walk the jury through exactly what is needed, what can be concluded at the end of the deliberation. So we'll definitely get more details about that tomorrow.
Okay, and as you say, they come back at 10 Eastern. Not knowing there is no way to predict what juries will do, and this needs to be unanimous to get a felony.
Right.
Have you heard any feeling? You were in the courtroom. Any gut? And I know you're a reporter, but any gut on who was stronger here, or what we're going to look for?
Well, it's interesting. There are a couple of things to point out here. One is obviously the prosecution is kind of the last taste in the jurors' minds, and so earlier on today we had Blanche kind of repeatedly say, here's an instance of Cohen lying in the past. Here is another instance, really trying to prove that they should not rely on Cohen to make their decision. And at the end of that, one might say, that was pretty strong. Okay, I'm seeing this. He's a liar. Why should I trust him, right? But then you go on to the prosecution. Obviously, it was 6 hours. There was a lot more, kind of painstakingly walking through so many different pieces of evidence. A lot of the evidence, as I just said, was Trump himself showing that he had knowledge of what was going on. Again, a tweet saying it was a reimbursement, documents with Alan Weisselberg, the CFO, his handwriting, and all of these different pieces. So after that, I think that anyone who was kind of worried about Cohen now realizes, well, it's not just Cohen as maybe they had thought before. They're reminded of every single witness before that because there were, a dozen or so witnesses. And so because the prosecution spent a lot of time detailing that, I think that does suggest or, maybe poke holes a bit at the defense's argument, which really focused around Cohen. So I think that could have been, a choice that maybe ends up backfiring on them. And then, of course, something to consider in our attempt to, figure out in advance what could happen is how long the jury takes to deliberate. And what I'm hearing from sources who I'm speaking with is that generally the longer the deliberations, the more likely it is that they, maybe a hung jury or something else that would, rule in, I guess you could say, the favor of Trump or rule not in the favor of the prosecution. So that's something we'll keep an eye out for as well.
Yeah. And as you say, the instructions tomorrow. Great job, Hadriana. Thank you. We really appreciate your time. That is Hadriana Lowenkron, a national politics reporter. She was in the courtroom today, and a lot for the jury to consider. In San Francisco, I'm Ed Baxter.
Joining us now is Saira Malik, CIO of Nuveen, for her take on markets. Saira, I think we can talk about a lot of different asset classes. I know you're quite gifted in that regard. But let's start off first with, I think the perception is that stocks have been rallying like crazy, and it's not totally the case. We have seen the S&P 500 rebound from a bit of a sell-off in April. And I was just having a look at some of the key names. If you look at companies like Microsoft, and Amazon, they're basically flat over the past 3 months. Meta is actually down a little over the last 3 months, and you have Apple, which has made a comeback. So it's a little bit of mix and match there in the market. So what do you like at the moment?
Well, I think definitely the market rally has been fairly narrow. First of all, it's been wrapped up by the strength of NVIDIA and their earnings last week. And Apple was another company you brought up. And Apple actually, while the quarter was not incredibly impressive because the stock was so underowned, that's why Apple rallied. What I make of the markets, though, is that there's two drivers from here, and that's earnings and the economy. First quarter earnings were very strong. 80% of companies beat earnings estimates, and that's a big driver for the markets. And then the economy has remained fairly strong. Manufacturing data has been, somewhat on the stronger side. Payrolls data remains, fairly strong. And all of that means our economy is still growing while inflation has stopped reaccelerating like we saw earlier this year. So all of that together is why the market continues to have a strong performance.
Yeah, the environment feels pretty good. It seems like, if you go back and look at the 2-year yield, the last time it was close to 5% like this, because investors, you get nervous about rising market interest rates. The S&P 500 was 1,000 points lower. So we've gained 1,000 points. That yield on the 2-year basically sideways. The level that the 2 years at is essentially, I guess, telling you might only get one, maybe two cuts from the Fed over the next 2 years. And yet the markets have hung in there. And I think it's interesting that you mentioned NVIDIA, but a lot of the companies that might be riding on the back of NVIDIA, companies that I mentioned like Amazon and Microsoft and Google, while Google's done pretty well, some of the others didn't really do much over the past month. So it does leave you with a lot of choices here in if you're trying to play AI, where to go to maybe get some gains.
Well, there's very limited winners in the AI space at this point that win no matter what. And those two companies are, first of all, NVIDIA, because it basically supplies to anyone trying to grow in the AI space. And second is Microsoft, which has had a very strong lead and head start in artificial intelligence by spending tens of billions in that area. So those are the two key players. That's one reason why NVIDIA continues to perform well. Second, for those concerned about NVIDIA and the rally that it's had, if you look at NVIDIA's PE ratio versus the semiconductor space, for 2025, NVIDIA is actually still trading at a discount. So the argument that NVIDIA is expensive really doesn't hold true. As for the markets going higher from here, continued consumer spending has been what's driven the markets higher. And inflation has stopped reaccelerating like it did earlier this year. So when we talk about less Fed rate cuts than expected, and why are the markets okay with that? It's because the Fed is cutting less for the right reasons. And those reasons are that the economy remains strong. So the Fed has said, okay, we don't need to cut as much because we're not imminently going into a recession.
At some point, the bond vigilantes may come back. We saw a little bit of weak auction sales today. It kind of brings to mind what happens when investors finally get worried about debt and deficits. Are we there yet?
I don't think we're there yet, but it is definitely a concern when we look at the level of U.S. debt and interest rates that are going to stay higher for longer. I think that is a long-term structural issue for the U.S., except it's not something, as we can see with the markets up, quite nicely year to date, that the markets are that concerned about. Switching over to fixed income as an asset class, I think, what you can lock in now is yields in certain areas that we haven't seen in many years and oftentimes decades. So fundamentally strong asset classes like municipal bonds, high yield municipal bonds are offering very attractive yields at this point.
Are you seeing any attractive options in Asia at the moment? I mean, obviously, this is Bloomberg Daybreak Asia. We tend to focus on Asia once we get past the initial Wall Street wrap up. What do you like out here?
Yeah, sure. So two things we think about with Asia and markets outside of the U.S., and that's currency and what's going on with inflation. With currency, I think that could be a positive outside of the U.S. because as the Fed finally gets the rate cuts or the economy starts to slow, that should make the dollar a little bit weaker here, and that's more positive for international investments. For Asia, I think Japan still has a lot of legs. Strong corporate governments and strong earnings are drivers there. And we have three themes in Japan: reopening, reflation, and reshoring post the pandemic. We like sectors like defense, artificial intelligence because of the demographics issues in Japan, exporters as the yen may weaken from here. And also we like companies outside of Japan in areas, for example, that are exposed to China, which is kind of lagged. And as that perhaps comes back with some spending, I think that could be positive for China exposed companies.
Bloomberg did a survey of a dozen economists looking at China, looking at the property market, and the efforts that we've seen here of late in terms of pushing some of the big cities to lower some of their buying restrictions for housing, it seems to be working a little bit. According to this survey, 7 out of 12 respondents see a jump across the board in China, and they're seeing growth improve. The economists see growth in 2024 edging up to 4.9%. How much of a concern for you is the property sector and whether or not it's ongoing in terms of stress?
Yeah, two areas of concern for us in China. One is the property sector. Two is trade issues with other countries doing less trade with China, including us. China has bounced off the bottom as portfolio managers from a global basis have come back in to buy in China. We have seen a pickup in some of the electronic spaces and luxury apparel spaces. But I think those two structural issues of trade and property are still ones that China may need to overcome. So, the question of do you want to chase China from here after some of the bounce off the bottom that we've seen? I would like to see more progress with the property sector and understand where the trade issues might bottom.
I've been looking very carefully at ways of playing, derivative plays on AI. And, some of them, like the independent power producers and utilities, have already seen a big bounce. The P's are kind of high. So let me put it to you. What's your number one pick in the AI sphere?
I think, you can look outside of NVIDIA, you can look at areas that may benefit as AI becomes more highly used. So one is infrastructure, which has multiple tailwinds. Number one is we need to build more manufacturing. This is U.S. infrastructure in the United States and even global infrastructure, in order to meet the needs of artificial intelligence. Infrastructure will benefit. Second trend for infrastructure, renewable energy. As we upgrade our grids, we'll need more renewable energy and more infrastructure. And then we can look across sectors like healthcare and financial services that use a ton of data, which is also very promising
Plenty
for
of
AI.
targets. All right, Saira, thanks so much for joining us. Saira Malik, CIO of Nuveen. Charlie Ripley, Senior Investment Strategist at Allianz Investment Management, for a closer look at markets. Charlie, in some ways, the auctions grabbed the most attention today. The U.S. Treasury sold $70 billion of five-year notes at 4.553%. That was above the pre-auction level of 4.54%. It doesn't sound like a lot, but it did send ripples through the market, and yields did pop on that, up 8 basis points. Are the bond vigilantes getting ready to do their thing?
Hi, Brian. Thanks for having me on. Yeah, when you look at today's auction set, there is a different set of investors that invest in, the 3-year and the 5-year and the 7-year space. And, I think today's tailing auctions, probably did feed into some of that negative pricing that we saw in the bond market. But I don't think it's going to be particularly reflective of what we might see in, maybe the longer end of the curve. I think those are a different set of investors, particularly insurance investors that are looking for longer duration. So it'll be interesting to see how that plays out next month. But, it's likely not, a precursor to what we'll see at auctions next month.
There was a Wall Street Journal story just a short while ago that broke, and I just want to mention it briefly and then ask you a question about M&A. Merck, according to the Wall Street Journal, is nearing a $1.3 billion deal for an eye drug company called iBiotech. We did actually have a flurry of deals getting some coverage today in the marketplace. Obviously, the big one was Hess Investors approving the Chevron $53 billion takeover. But another one involving Energy Transfer acquiring assets from WTG, and also T-Mobile acquiring some of U.S. Cellular's wireless operations. And it begs the question about whether this pickup in M&A that we're seeing, is it sending a broad message, or is it too early to say?
I think it's too early to say. Typically, in a higher rate environment, it's harder to see some of these larger M&A deals get through with interest rates at these levels. So, I think, because we've been at, high interest rate levels for some time, maybe there's a little bit less patience to get some of these deals done. But, I think the real catalyst is going to be, a lower interest rate environment that really drives, additional M&A activity.
And do you see a lower interest rate environment coming?
That's a great question. And I think, when you look at the set of probabilities and, a data dependent Fed and, everything that's happening on the inflation front, I think the path of probabilities is a little bit wider than expected. And, I think people are a little bit less convicted about the directions of rates in this environment. You did mention we have seen, some mixed data sets on the economic front. And even when you look at the Fed speak from policymakers, Neil Kashkari's comments today, alluded to, the potential for rate hikes should they need to move in that direction. So, against this backdrop where, we have a very data dependent Fed and a very reactionary function from them, I think it's going to be, difficult to have a high conviction of anything in any direction if they're basing policy specifically on inflation data.
Yeah, is it dangerous to a certain extent that the Fed is data dependent in that it's sort of disallowing itself from getting out in front of something? And I talk about that because you have a lag in the lagged effect. I mean, we're not seeing the strong impact on the economy that we expected from higher interest rates, and we're also seeing a kind of slow lag in inflation coming down to where we think it should be. So should the Fed make a call and act on it, or do you think it's right to be data dependent?
I think they've committed to the data dependent, transparency view. You look at, December of last year, they let the proverbial genie out of the bottle when they decided to forecast 3 rate cuts for the year. And, perhaps maybe they did get a little bit ahead of themselves in terms of being a little bit preemptive there. But, I think the reality is, the data is moving slower than what they may have expected back then. And they have to adjust to that today. And I think that's why we're seeing, market pricing from market participants on rate cuts continue to go lower and lower or get pushed out further and further.
Yeah, we're just reminded sometimes of the differences in the way central banks look at interest rates. For instance, in Europe, they don't mess around with owner's equivalent rent. And so our data pumped through their system, inflation would be running around 2%. It would be acceptable. But since we do have this owner's equivalent rent and sort of a lagged input into the numbers from that, we're stuck in this position. Do you worry that that inflation is going to stay high too long, or do you think that, hey, it's really not all that bad at these levels, and the way we know that is look at the markets?
Yeah, I think that's a great question. Obviously in the first half of this year so far, we've seen, the impact on service inflation, particularly rents, and how that's been a lagging factor. But, when we think about how the Fed, should position through that, it really makes sense for them to be data dependent. But on the one hand, they have to understand that there is a lagging effect to the policy here.
I suppose what most people are doing here is kind of enjoying the best of both worlds. They've got a lot of cash and they've plowed that into short-term treasuries. And then, they're playing in the equity markets with X number of dollars kind of addressing the AI frenzy and X number in just sort of good old-fashioned industrials and materials and that sort of thing. Is that the smart way to play this, or do you have a better way?
Yeah, I think if you look at, bond yields historically, they've been fairly low for the last decade. And, you go back to the 2000 to 2010 era, 10-year rates averaged a little bit higher than about 2% higher than where they were at in the decade following, the great financial crisis. And I think, an investment strategy that looks at, long duration to hedge against, some types of systematic risk can be problematic. And we've seen that, throughout this hiking cycle as rates have risen. And so, I think it does behoove investors to look for other types of strategies, to mitigate those risks, whether it's investing in cash or other derivative-based ETFs that might, benefit a portfolio structure overall.
So are you leaning toward opportunity here or caution?
I think we lean towards a little bit more caution. I mean, there's a lot of uncertainty around the path of inflation. We look at the data set, we look at, the hawks and the doves that comprise the FOMC. I think, they really want to cut rates at some point this year, but the inflation data isn't allowing them to do so. And
all right, Charlie, we got to go. Thanks so much for joining us. That's Charlie Ripley, Senior Investment Strategist at Allianz Investment Management. This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.